Hi, everyone. The stock market here in Canada has notched several record highs across multiple sessions so far in 2026, even as the economy itself may not feel the same way. In today's episode, I sit down with Mark Rutherford, who runs our Canadian equity portfolio, to dig into the gap between the two. What's really driving this market? Why having a much higher weight in one sector than the index is actually more diversified, not less, and what the wild year in gold has taught him about sizing a position. Enjoy. Welcome back to the podcast, Mark. How are you?
Good. How are you?
I'm doing well. It's good to have you back on. I actually wanted to jump right into it because I need you to help me figure something out. We've got this economy here in Canada that feels, let's say, soft right now. We've got housing that's weaker. We're at the very least flirting with a recession, although no one wants to say that word. And yet the market has hit several record highs so far this year. So what am I missing?
It's a unique situation in Canada. People might see or feel day to day in their lives in terms of the labor market or immigration growth in Canada that has really slowed, or the housing market. That is a pretty big disconnect with what we see as the fundamental earnings drivers in the market. People will know that commodity sector, both energy and materials names, are a large portion of the market in Canada. And those, a very small amount of the population works in, but it's a very large contributor to corporate earnings in Canada. And that is driving a large proportion of the returns over the last year, as well as banks. And banks are, while they're not growing rapidly in Canada in terms of loans, the wealth management business is doing really well. And so are the capital markets businesses that are doing well, as they're a little bit more diversified outside of Canada and broadly pick up global market strength. And so that's really at the core of what's driving some of the big disconnect that you might see or feel when people talking about us in Canada really kind of bumping around 0% real economic growth.
So it's the economy is not the stock market's not the economy. And in a way, they are each telling kind of completely different stories. And a big part of what's carrying the market, as you said, is the banks, which actually leads me to something that comes up in client conversations about how we're positioned. And so if you look at the portfolio, it's actually about, I think the most recent number I saw was 38% in financials. That's even more than the index. So on paper, that looks like kind of one big bet, and it actually looks more concentrated, not less concentrated than the index. So just walk us through how that's considered a diversified position from your standpoint.
Yeah, it's important to note the diversification amongst various sectors within the TSX can vary quite a bit over time. If we were having this conversation in 2020, you'd be looking at much lower weights in financials and across commodities. And that's totally flipped a few years later. And as we peek under the hood, within financial specifically, there's really a few categories in there. There's banks that are just over 20% of the market. There's life insurance companies. There's property and casualty insurance companies. There's alternative asset managers. And then we also have exchanges. And so when we actually look under the hood, we have identified in Canadian equity strategy a number of companies that on their own right, we think are great wealth creating companies. They out-earn their cost of capital, whether that's exchange operators in Canada or private equity alternative asset managers such as Brookfield. And each of those companies provides actually a unique correlation and a unique exposure and driver of the underlying returns. So while it all might get lumped together in the financial sector, it does broadly, under the surface, have very different underlying exposure. And so if we look at a precious metals asset manager in Canada, such as Sprott, that's a business that's really driven by flows into their leading gold, silver, copper, and physical trusts that they have, and uranium as well. So that's a financial, but it's really a wealth management business and an asset management business. And so that's a very different return than the investment bank at Royal Bank of Canada. And what's going to drive that is going to be a little bit more pro-cyclical. So when we identified all these, we do them on a bottom-up basis. That's our process here. And then we stack up how those look relative to one another. And the nice thing about having really a range of these within our financials exposure is if there's strength in one and weakness in another, we can quickly shift, and we know all of those businesses very well and can adapt to the environment. And one other thing that I think I'd point out just within the insurance versus the banks, P&C insurance, such as Intact or Fairfax Financial, they would be much different, really underlying return drivers than more pro-cyclical banks. So they're at Intact, for example, much more geared towards underwriting profitability, growth of insurance premiums, and a little bit of performance on the investment float that they earn, but that's fairly conservatively invested. And so that's just a much different exposure than the banks where, pro-cyclical, they want loan growth, they want a steep yield curve, and they want really robust capital markets activity. So as we stack it all up, the exposure today, it's somewhat a function of what's done well in markets. And so you see Royal Bank and TD at top weights in the portfolio, and they've deserved that. So they've earned the right to be there. But since they've gone up so much, and we can get into this more, we have recycled some of that capital into other areas.
Yeah, I'd love to hear more about that kind of the work that you've done to kind of rotate the exposure within the financials generally. And you kind of touched on it already, but you can't escape the interest rate conversation when you're talking about financials. And maybe you can talk a little bit more about how rates don't even hit all of those businesses the same way.
Sure. Yeah. So one area that we've recently recycled some into has just been the P&C insurance companies. So we've seen a similar increase in return on equity over the last few years. And so structurally, these businesses appear a lot more profitable than they were. And that appears reasonably likely within this range to be sustainable. They continue to have growth opportunities, and they're trading at lower valuations and attractive return. Our assessment is the return there is a little bit more attractive than what we've seen in the last couple of years. And the banks is really the opposite. Historically, the banks in Canada have traded from 10 to 12 times earnings. And really in the last year and a half, have re-rated to closer to 15 to 16 times earnings. And similar story there. Their return on equity is a lot higher now. And that's partly a function of the wealth and capital markets businesses growing and being a bigger portion of their total profits. And wealth is a very attractive business. You have nice annual tailwinds. They can grow and take on new clients still. They're capital light for the banks, so they don't require much regulatory capital because the banks aren't putting capital really themselves at risk, taking on new wealth clients. And so the flip side of that is you're paying 15 to 16 times. And if the markets are down a tremendous amount in a sell-off, they're very exposed there as it's directly correlated to revenue. So that's one area. We've also just found some idiosyncratic opportunities within alternative asset managers in Canada that we think are very well positioned to do well over the next 2 to 3 years. And so we've continued to just slightly adjust as the bank's positions have become much larger weights in the portfolio.
Yeah. So even though this all shows up on the page, as you said, just as one word, financials, underneath you've got businesses that can move in actually kind of opposite directions at times. So I guess that's the what you own side of it. The other side is kind of what you actually do with something once you're in it. And I think I want to pivot to gold because I think it's a good example to explore this topic. You gained exposure in the portfolio there for some further diversification and some hedging, and then you trimmed some back as it ran. So how do you think about kind of taking profits on a winner like that, and what lesson is in there on sort of not letting any one position or exposure get too big?
Yeah. So for context, we've really, since the first half of 2025, started adding more gold exposure to the portfolio through royalty businesses and Agnico Eagle. And really, the thesis there is at current prices, trying not to make a call on where gold is going, but at current prices, their returns are a lot more attractive. They're largely debt-free businesses, and they're going to generate significant free cash flow that they can then return to shareholders. And they appear to be slightly more disciplined than in the past in terms of doing M&A just for the sake of getting bigger. And so we like that setup, and it has the added benefit, just from a portfolio construction point of view, of providing just a different correlation. And gold is a little bit unique in that oftentimes the correlation can change. So sometimes gold can act as a very risk-on beta type asset, but it can also act as a much more defensive, uncorrelated asset at times. And so that's the benefit. And the challenge is that correlation changes over time. So, like I said, we built that up based on just improving unit economics and fundamentals for these companies. As it's rallied, the combined weight in the portfolio grew to around 12%. And so it's getting to be a bit larger weight, especially as gold was approaching $5,000 an ounce earlier this year. In conjunction with that, this Iran conflict has really changed the outlook for a couple things over the short to medium term, and that is interest rates and the likelihood that central banks may be cutting rates. So the market appears to be more concerned now that there won't be near-term rate cuts, and gold often performs probably better when the market thinks the Fed is about to cut rates, and it's in a low rate environment, gold can be more attractive. Versus now, we're a little bit more in the situation where central banks are likely on hold for the short to medium term, and we're seeing higher inflation creep into the numbers. And so that gave us some pause earlier this year. And then in conjunction with that, the companies are noting that even amongst their own operations, they are seeing some moderate to high levels of inflation. So you can think of all the gold and material companies globally. A lot of them have raised money over the past year to really 5 years in a higher price environment. And now they're really starting to deploy that capital to start brownfield mines, do new greenfield mines. And that capital is now working its way through the system. And the mining industry, it's not the largest industry in the world. So that's having an impact on labor rates, suppliers, and then there are obviously a lot of the businesses are heavy users of fuel at some of the mine sites, just given the remote nature. So when we combined all that, different rate picture, some of the valuations had run up, and some inflation creeping into the numbers, we've trimmed back the position slightly and still hold a reasonable size weight in the portfolio. I think they're even at $4,000 and $3,500 an ounce. We're seeing attractive returns through our DCF models. And yeah, so it's really just trying to adjust the portfolio and stay on top of these positions as some of the factors really outside of the business, whether it's inflation that we talked about or interest rates, are defining what some of their unit economics will look like going forward.
And this is also another great example of what we just talked about within financials, in that within a narrow lane, you can gain exposure to different return profiles. In this case, you can do it through a streaming or a royalty business. You can do it through mining business, or in the case of Sprott, it sits in financials, but it's got exposure to kind of a similar driver of things. And so you get a mix of business models within this space. And if there's one thing that I've learned in talking with you and others on the team over the years, it's very much what you just talked about, in that the discipline is as much about trimming the winners and getting positions right than it is about finding the winners in the first place, which feels like a really good place to kind of step back and just ask a final question for you to take really in any direction, Mark. But if someone takes just one idea about diversification away from this conversation for really any market, not only Canada, what's the biggest trap that you'd tell them to avoid?
Yeah, I think it's a great topic and question. From our perspective, and my observation is really that over the last 10 years, the indexes have become the highly concentrated vehicles to invest in. And you see that with the Mag 7 and the technology concentration in the US market. I joke that the rest of the world has become more like Canada because Canada's kind of always been known as a bit more concentrated in terms of financials and commodity exposure. But now, really across a number of markets, we're seeing that the index is the highly concentrated vehicle with a few drivers and a few themes driving mega cap stocks in the same direction. And so I think it's just important for investors to be aware of what their exposures are. And there's no right or wrong in terms of whether you want that highly concentrated exposure, but to know that the index, that's what really today the indexes are comprised of. And the process and really the philosophy here is bottom up. We're looking more broad at building really brick by brick these broadly diversified portfolios of wealth creating companies that are providing unique exposures. They're still going to be correlated to the broader market, but I think we're doing it in a way that provides just a lot more diversification over time. And I think ultimately that, yeah, we believe that's going to result in superior results and superior returns. And that will take time, but yeah, we're long term. That's one of our core values. And yeah, I think that's just a really important part to note when people are thinking about just the traps of looking at some of the labels on the market in terms of how diversified they are, the need to look under the hood, and then comparing something like Canadian equity strategy or other strategies that more to indexes in the market. And no right or wrong answer, maybe both are a solution. But yeah, the indexes have just become much more concentrated over time. And I think an opportunity for us and a lot of other investors that are pursuing a little bit more broad diversification and finding still the same, think return or better return prospective investments, but just in different companies that aren't the top weights in the market.
You're touching on a topic that a lot of people are opening their eyes to these days, let's say, in that it's really about just making sure that you're aware of what your exposures are and then making sure that those exposures are deliberate rather than just accepting what maybe an index is giving you on any given day or any given timeline. Mark, we've covered quite a bit of ground here, actually. And I always appreciate your time and your insights into the portfolio and really just investing in general. So thanks for joining.
Thanks, Andrew.